Last time we finished up, we were talking about the NPV-GO formula, and we said that the price of a share of stock was the cash cow value of that share plus the net present value of the growth opportunities of the firm per share. And now we're going to use that formula to kind of break down what PE is. PE is price per earnings. And so we're going to start out with our NPV-GO formula, and then we're simply going to divide both sides by earnings. If I divide both sides, by the way, share price is per share, EPS is per share. If I divide both sides by EPS, the share cancels out. I end up with price divided by earnings. And what's left over on the right-hand side is 1 over R plus NPV-GO divided by EPS. And so we can actually break PE ratio down into two components. The first has to do with the risk. Remember, risk and return go together. And so the higher the risk a firm has, the higher the required return, the lower the PE will be, all else equal. Let me say that one more time. The higher the risk, the higher the required return. And so as R gets larger, 1 over R gets smaller. So all else equal, the riskier firm will have a lower PE. Okay, now, what about the other part? Well, the other part has to do with the size of those growth opportunities per share versus the current earnings per share. And so if your growth opportunities are outstandingly large compared to your current earnings, then your PE is going to be higher. If you have zero net present value of growth opportunity in NPV-GO, then it's going to be totally dependent then on the risk. And so what kinds of firms would we see that would have a high PE? Safe firms with high growth would be the ones that I would consider to have, or that mathematically are going to show to have a high PE ratio. How often do you think it is that we have a high growth firm with low risk? Yeah, it's not often seen together. Usually if there's high growth, there's higher risk. So don't think that there is this one great firm out there that's going to be safe and have high growth. So let's take a look at some different PE ratios and see what's contributing to them. First of all, remember this is a mid-2015 is when I snapshotted these. So ExxonMobil, 12.6, one of the lower PE ratios up there. Fairly safe. Is it growing really fast? No. In fact, even at this point, people were talking about the end of fossil fuels, right? What about Ameren? Ameren makes electricity. Do you think that is a risky undertaking? No. But is it a high growth undertaking? No. And so it's this lack of growth that allows us to see a low PE ratio for Ameren. And I threw gold mining in there just for fun. It's around 20. Let's move on to Starbucks. Compare the PE ratio on Starbucks to all these other PE ratios that came before it on this list. What do you notice? Yeah, it's really high. And here's why. Do you think it's because Starbucks is extraordinarily safe or because of their growth prospects? Or it's the growth. Okay, so example here. My wife and I moved to Mississippi in 2006, a town called Hattiesburg. On the way in for our first day at work at the University of Southern Mississippi, we passed a Starbucks. And my wife says, oh, hey, they have a Starbucks. And I'm like, great. And then on the next day into school, we passed 2 Starbucks. And I'm like, wait a minute, did we just miss that one on our first trip into town? And my wife says, surely we did. And what happened is, though, these Starbucks just keep popping up. They're like weeds. And this was happening all over the country. And so Starbucks was a big growth story. And by the way, those new outlets were profitable. They figured out that people would actually sit in a drive-thru for Starbucks coffee. How insane is that? Okay, now, moving on. What happens in 2008, 2009? Say again?
Recession.
Yeah, we got a recession. At that point, we've got unemployment pretty high. Do you think people are wanting to spend $4 for a cup of coffee? No. And so people said, wait a minute, the Starbucks growth story is over. And Starbucks said, no, we're going to expand into China. And all the smart people said, China is a tea culture. There's no way that Starbucks will ever be successful in China. So I go over to China in late 2010 or 2011, and I'm surprised to see there is a Starbucks directly across from my hotel. And then I get to my classroom. By the way, kids in China eat breakfast in the classroom. So they're sitting on the front row, they're eating their breakfast, and they've got Starbucks cups. And the first question I ask is, do you actually go to Starbucks or do you just keep the same cup? Because sometimes that's like a status symbol, right? The whole Starbucks cup. And they said, no, we were there this morning. I said, are you drinking coffee or tea? They said, coffee. Yeah. Now, Starbucks managed to do something no one else thought they could do, and that is to get Chinese people to drink coffee. And so Starbucks takes off in China and grows. So the growth story continues. Then China growth starts to taper off. Starbucks says, no need to worry. Now we're going to India. Oh, for shame, she's late. Okay, so now they say we're going to India. And the smart people say, well, they'll only be moderately successful there because India is tea culture in the north and a coffee culture in the south. And I say, horse crap, right? If they can convert Chinese people to drinking Starbucks, then they can convert the other half of India. Anybody here from India? Is there Starbucks near you in India?
Yeah.
Is it popular?
Yeah.
Do they seem like they're making money?
Yeah.
Yeah. Okay, so that's why Starbucks PE ratio is high. It's because of the growth. Let's ask one more question here. Starbucks in Vietnam.
Yeah.
Yeah, but is it very successful?
No.
No. Why? Vietnamese people make great coffee.
Yeah.
Yeah, that's why. Because the coffee's better at the Vietnamese joints. And cheaper, right?
Yeah.
Yeah. Okay. So that's Starbucks. Now let's start looking at pairs of companies here that are in roughly the same business. What about Walmart and Costco? Walmart's got a PE ratio of around 15, Costco around 27. Do you think one of those is fundamentally riskier or safer than the other? No, it's all about the growth story. Think about Walmart. Walmart, you can't swing a dead cat without hitting a Walmart, right? Especially in this part of the country. You have to get basically into urban areas before you see anywhere that doesn't have Walmart. So what does that mean for their growth opportunities? Here in the States, it's pretty low, right? And so then Walmart says, well, we'll grow overseas. And what we've seen is that Walmart's foreign adventures have not been as successful as you might think. They had to sell out in South Korea. I think they sold their German operations, and I think they've even sold out now their UK portion of Asda. And so they've really not been as good over there as they could have been. Now let's compare them to Costco. Where are Costco's primarily located?
Urban areas.
Urban areas. By the way, we recently got our first Costco here in Springfield. But if you look at the big old map of the Costco constellation, most of them are on the coasts, right? And they've only recently started penetrating this area. Lots of more growth opportunities for Costco. Lots of more growth opportunities for Costco. The other thing that I would say is that Costco executes better than Walmart. When is the last time that you went into a Costco and you saw that it was dirty and someone was changing a baby diaper in the aisle? Never, right? But you see those things at Walmart, right? And so Costco is fundamentally doing a better job than Walmart. So let's look at another pair, Apple and Lenovo. What does Apple make? Technology. Let's talk about specific products. What do they make?
iPhones.
Oh, very good. The iPhone. What else?
MacBooks.
MacBooks. What else?
iPads.
iPads. Okay. Let's. You may not know Lenovo, but Lenovo is a Chinese company. And Lenovo actually bought IBM's PC operations, so we know that they make PCs. Lenovo also makes phones. In fact, they bought Motorola. And so they've got these two iconic American brands. And nowadays, if you buy a ThinkPad, it's not IBM, it is Lenovo. So they're selling basically the same kind of stuff. But look at the difference in PE ratio. You guys probably expected Apple to have the higher PE ratio than the no-name Chinese brand. But here's the difference. Apple's products, are they high price or low price? High price. Lenovo stuff is more affordable to the masses. In the United States, almost everyone could afford an iPhone of some variety if they wanted to. Is that true in the rest of the world? No. In fact, if you go to India, a new iPhone would be out of the reach of the vast majority of people, and they've got like 1.5 billion people, right? But could they afford a basic Lenovo phone? Absolutely. Now, here's the next thing you need to know. Does the world have more rich people or poor people? Poor people, right? So who's got the greater growth opportunities here, Lenovo or Apple? Yeah, it's got to be Lenovo. Now, moving on to Yahoo and Google. Yahoo has since been bought in a stupid acquisition by Verizon. By the way, anytime you see someone buying a company that's almost dead and telling you that they're going to merge it with themselves and make something amazing out of it, just know that they are either insane or lying, right? Because it doesn't work. Okay, so back when I took this snapshot, Yahoo still was a standalone company. It had a PE value of 5.54. Google's was 25.1. What's the difference?
Google was expanding.
Yeah, Google was a growth stock, and Yahoo was a dying company. Yahoo was a dying company. And so Yahoo was actually shrinking, Google was growing, and so once again we see the growth pushing up the PE. Now let's talk about Pfizer and AstraZeneca. They make pharmaceuticals, which by the way are those things that you get when you go to the pharmacy and you have to have a prescription. Those are pharmaceuticals. And if you want to know about the growth prospects of a pharmaceutical firm, all you have to do is look at their pipeline. What is the pipeline for a pharmaceutical company? What does that mean? Well, you've got a bunch of geeks in a lab, and the geeks in a lab are going to come up with chemical compounds. And then that's the beginning of the pipeline. And then they're going to test those chemical compounds on, say, small animals, right? And then they're going to, if it works out well on the animals, then they test it on who? Humans. And they do that. In fact, we do this here in Springfield a lot. This is one of our core industries, is testing drugs, because people around here are like, yeah, give it to me. Okay. Anyway, so if it works on a small group of humans, then we go with a bigger group of humans, and finally, we may get FDA approval, Food and Drug Administration. Now, do you think that everything that starts out down here as a wacky idea between some freaky chemists in the laboratory winds up being a commercial product? Absolutely not. There is attrition as we go along. For every 100 ideas that get in the end, in this end of the pipe, maybe only one of them survives. Now the good news is we, as people, we can look at what the pipeline is because they have to disclose this stuff to the FDA. And so analysts can look at this and say, well, hey, look, they've got this, in theory, possible blockbuster drug against diabetes in their pipeline, and it looks like it may come to market next year. So the more good stuff you have in your pipeline, the higher your growth prospects, the higher your PE. Who's got the better growth prospects here, AstraZeneca or Pfizer? That's got to be AstraZeneca. So this is one of those things that you could do if you wanted to figure out what a pharmaceutical company's pipeline looked like. All you have to do is look at their PE ratio. Questions? Okay, now let's talk about two more. Amazon and Alibaba. On the day that I took this snapshot, Amazon's PE ratio was NA. What does NA mean? Not available, not applicable, and here's why. In order to have a PE ratio, you have to have positive earnings per share. And at that time, Amazon was basically reporting either loss or break even. And in fact, this got to be a game. Amazon were would record loss or break even, and then people would start to sour on Amazon stock. And Amazon then would magically turn a profit, and the stock would go up, and then they go right back to not making any money or losing a little bit of money. And they did this several times. Now, are they reporting profits now? Yes. But what were they doing back then? Remember we said about the life cycles of a company? What was Amazon building out? Okay,
Cloud service?
well, so they're building out the cloud service, but all these warehouses, if you get on the James River Freeway and head out west of town, and when you get to Republic, you're gonna see this huge Amazon warehouse. Do you think that requires a little bit of money to do? It requires a boatload of money. And so they were not reporting earnings. They were basically holding all the cash inside the firm that they could. They were minimizing what it looked like they were earning. But when they needed to produce a positive profit, could they? Yes, because what would they do? They would use their discretion under the generally accepted accounting principles. Does this mean there were scumbags involved? Absolutely, because people are scumbags and we know people are running Amazon. Now, moving on, what about Alibaba? I don't think we have anyone from China here, but we have someone from Taiwan. What is Alibaba?
It's a firm founded by Jack Ma.
Yeah, Jack Ma. And by the way, it's Jack Ma? Horse? Right?
Jack Ma, yeah.
Yeah, so when you hear a Chinese person named Ma, if you call him Ma, what does that mean?
Horse.
Horse? No, how about Ma? See, my Chinese is so bad. Okay, one of them means mother. One of them means horse. And if I don't say Ma, they all laugh because they think I'm calling them Ma. Okay, back to the story. Alibaba is roughly in a similar kind of business as Amazon. Why is its PE ratio so high in 2015? What did we think in 2015? The sky's the limit for China, right? What do you think it looks like today? Yeah, I'll bet it's much, much lower. In fact, we can look it up later when we're looking at stock quotes. That's PE. What's driving it? Risk. Risk drives it down. Growth drives it up, right? Questions? Yeah?
Why wouldn't you look at, obviously with context, you know it's not true, but why wouldn't you look at Yahoo and be like, oh wow, this is super low risk?
Oh, okay. Well, first of all, everyone who is putting money into the market should be tuned into what the hell's going on, right? And if you're reading your Wall Street Journal, you know there's just story after story about the suck at Yahoo, right? If you can't be bothered to read the Wall Street Journal, should you be buying individual stocks? No, in fact, you shouldn't be buying individual stocks anyway. You should be buying the index. But if you're going to be the kind of person that does buy individual stocks, for crying out loud, read. It's so funny. People look and then they think that you can just look at the PE ratio and decide whether or not it's a stock to buy. Just looking at the stocks. And so I had some Chinese students and they said, should we buy low PE stocks? And I say, yes. And they said, should we buy high PE stocks? I said, yes. Now they're really confused. They say, should we buy mid PE stock? And I said, yes. Now they're really confused. And I said, look, buy them all. Because you're not going to be able to look at things like PE and know whether or not a stock is a good investment. Does that make sense? Good question. Other questions?
Does a higher growth make the firm safer then?
Oh, absolutely not. So what do you think has more uncertainty? Something that's growing leaps and bounds or something that's been growing steady 2% a year forever?
Growing leaps and bounds.
Yeah, it's got to be riskier. And I see this all the time. People are like, oh, wow, that firm's growing 10% a year. That's going to go on forever. Horse crap, right? The question is, when's it going to stop? Does that sound like risk? When's it going to stop? Yeah. Took my wife years to get me to say crap. Okay. Instead of something else.
Providence.
Yeah. You can teach an old dog new tricks. Okay, now we're on to stock features. Let's talk about common stock. Remember, we said common stock were the people at the very end. They were the residual claimants of the firm. First of all, let's talk about dividends. A lot of people get confused and think that firms have to pay dividends. They don't. They don't. In fact, the dividends are not a liability of the firm. And remember, liability is a legal obligation to pay. They are not a legal obligation to pay until they're declared by the board of directors. Every time that firm pays a dividend, the board has to have met and approved that dividend before it gets paid. And if they don't approve it, it's not a liability, which means they don't legally have to pay it. So here is a common test questions that students miss. Are you ready? A firm has been paying a dividend of $1 per quarter forever. Do they have to pay a dividend of $1 next quarter? No. No, they don't. Until it's declared by the board of directors, it's not a legal liability to pay. Okay. The next thing to know is that the payment of dividends is not considered a business expense. Now, why do we bring this up? If we go back to our discussion of debt, we saw that interest is considered a cost of doing business. As a result, you can subtract your interest before you calculate your taxes. But that's not true of dividends. In fact, dividends, if you look at state income statements, the dividends happen after the net income is calculated. And so we know that the dividends don't impact your taxes at all. And so they do not have the tax benefit that debt does. This last one, the law changes a little bit on this. They've started messing with it. Now you can scratch through this and write 50% corporate exclusion. I doubt I would be asking you about such a thing on an exam. Let's talk about this. If you're an individual, then your dividends are taxable as are taxable. They used to be taxable as regular income, just like the money that you make on your job. And then in 2003 or so, they started taxing dividends at a lower rate. Why would you tax dividends and capital gains? Why would you tax them at a lower rate? What are you trying to encourage?
More investment?
Yeah, more investment, right, to expand the economy. And the idea is that eventually the growth will be enough to produce taxes to make up for that lost revenue. Okay, now individuals are taxable. My dad loves to brag about how much he managed to make in dividends last year without having to pay any taxes. Because now they've messed it up to the point where based on your other income, which for him would be Social Security, based on your other income, you might or might not have to pay taxes on your dividends. And now they've got two kinds of dividends, qualified and non-qualified dividends. It's a big old freaking mess. How do I deal with it? It's called TurboTax, and it's not expensive, right? Okay. Now, that's how it's handled for individuals. For corporations, we say that you only have to pay taxes on the first 50% of the dividends that you receive. And you say, wait a minute, why should corporations get a break that the average Joe does not? Let's walk through it. Think back to our Chapter 1 discussion of double taxation. When the company makes $1, they have to pay corporate taxes, and now they pass that on to you at a dividend, but what's left over is like 65 cents, and now you have to pay taxes on it a second time. And so that's called double taxation. If I have a corporation that owns another corporation, and the small corporation makes $1, and then they have to pay 65 cents in corporate taxes, and then they pay that 65 cents to the mother company, and then they have to pay taxes on it again before they pay it out to their shareholders, then that is triple taxation. And apparently double taxation is perfectly fine, but triple taxation is a bridge too far, so now we have, 2.5 taxation, whatever you call that, somewhere between double and triple. So that's the idea here. It's not a bunch of corporate fat cats getting off with easy because they have friends in Congress. It's because we're trying to avoid triple taxation. Any questions? Yeah.
Can you explain more on double taxation?
Okay, double taxation, when the corporation makes $1, they have to pay what's called corporate income tax. So let's just say it's 25%. That means of that dollar that they make in profit, they have to pay 25 cents in taxes. How much of that dollar is left over to pay to the shareholder? 75 cents, right? So that's the first taxation. Then they turn around and pay that 75 cents out in a dividend to the shareholder. And then the shareholder puts it into their TurboTax, and lo and behold, they have to pay 20% of that. 20% of 75 cents is 15 cents, I believe. And if you follow that to its conclusion, it means that the shareholder only gets 60 cents. So we went from having $1 to having 75 cents to having 60 cents. So what's the effective tax rate there? It's actually 40%, right? That's double taxation. But what if this company had picked up that dollar by investing in another company over here that actually had earned $1.20? And then they end up paying taxes, and then only $1 comes to them, and comes. Do you see how now it would be triple taxation? Does that make sense?
Is it the same for an S corp too?
I do not know about S corps. I'll tell you straight up, I don't know about S corps. S corps, from what I recall, and it's been 20 years since I've dealt with it. Well, more like getting close to 30. Okay, so what I recall is that S corps are limited liability, but that the income from them is treated as regular income to the owners instead of being subject to corporation taxes. Does that sound right?
Yeah.
Yeah.
It's treated as like an income tax.
Yeah, and so, and typically, S corps are not going to be publicly traded, are they? Oh, okay, I don't think so.
I don't think so.
Yeah, she says no, so I'm going to believe her. She looks very smart. What's that? They're not double. Yeah. So there, now you can breathe easier.
Yeah.
Yeah. So they're going to be taxed just like an LLC or a partnership. Questions? Okay, next. Let's talk about shareholder rights. Who makes the sorry, I gave away the answer. Who makes the decisions at the firm, at any business? Who makes the decisions? The owners, right? And who are the owners of the corporation? The shareholders. And so the shareholders have these rights to make decisions. And how do they go about that decision making? They have the right to vote on stockholder matters of great importance. Now, keep in mind, we talked about this earlier in chapter 1, the stockholders can't all get together every day to discuss what's going on at the firm. And so what do instead? They elect the board of directors to represent their interests at the firm. They elect the board of directors. Now, that gives them the right to elect these directors, and when they're unhappy with the directors, it also gives them the right to get rid of them. So that's the most important thing that they vote on. We'll see that they also usually are involved in voting on mergers and acquisitions. And we have this thing in the United States called proxy voting. Proxy voting, as an American, we take it for granted. And that's the idea that you don't actually have to be at the shareholders meeting in order to be able to vote your shares. The proxy says I can give my right to vote my shares to someone else. Or I can submit a proxy ballot, and that ballot stands in for my presence at the shareholder meeting. And so proxy voting allows anyone. So my dad owns stock in Walmart. He only lives 90 miles north of the place where they have their shareholder meeting every year by the Walton Arena at the University of Arkansas. He could easily jump in I won't say his pickup truck, it's about to die. He could easily jump in Mom's car and drive down there, vote his shares, and then go home. But why would he? He's got things he would rather do, like sleep. And so it turns out that this proxy voting allows something interesting. It allows people who don't have a huge financial incentive to vote their shares, to drive to the shareholder meeting. It still allows them to vote their shares. And so proxy voting gives representation to minority shareholders. When we say minority, we're speaking about less than 50%. And in fact, you might still own 20% and want to go to the shareholder meeting. But take me, for example. I own 1/1000th of General Electric. Do you think I would ever be incentivized to go to their shareholder meeting? 1 billion! It would cost me far more to go to the meeting than I would ever get as a result of standing up at the meeting and saying something really profound, right? It's not gonna help me. But would I be willing to mail in my proxy? Yeah. And do we even have to mail it in anymore? No, the proxies are electronic. And so you could go vote for them or against, but of course the only time that I actually exercise that right is when I'm mad about something, right? Or with Halliburton, we used to have this guy named Lord Clitheroe that was on the board of directors. And I'm frankly an anti-aristocrat, so I would always go vote against Lord Clitheroe. Okay, now, proxy voting, we're going to see later on, proxy voting is important for another reason when we get to chapter 21. We're also going to have the right to share proportionally in all dividends paid to common shares. What does that mean? It means if I own 10% of the common shares and they pay out $10 million to the common shareholders, I get $1 million. Those cash flow rights are sacrosanct. I get that money. Now we're going to see in a bit that there are different share classes, but they all have the same cash flow rights. Let's see what else we've got here. Share proportionally in all assets remaining at liquidation after all the liabilities have been paid off. So let's talk about bankruptcy. In fact, let's make it really easy and say it's liquidation. The bankruptcy trustee sells off all the assets, and now the bankruptcy trustee has a huge pot of money, and they pay the taxes, and they pay the employees, and they pay the debt holders. And then they get to this group of other people we'll talk about today, the preferred shareholders, and they pay them what they're owed. And then at the very end of the line are the common shareholders. And so then everybody looks into the pot and sees how much money is left over. Usually it's nothing. By the way, who gets paid before the common shareholders? Actually, the first people to get paid are the lawyers. Right? Lawyers always win in bankruptcy. It's one of the few groups of people that always win in bankruptcy. It's lawyers. We get to the end, there's usually nothing left. But if there is, and I own 10% of the shares, how much of that pot do I get? 10%. Does that make sense? By the way, I've owned shares in 2 companies that went bankrupt. My dad's owned shares in 4 companies that have gone bankrupt. Can you guess how much money either one of us have ever received as a result of the bankruptcy process? Goose egg, right? Now let's talk about cumulative versus straight voting. Remember we said we're going to elect the directors, but it turns out there's more than one way to vote. In the United States, we typically say one person, one vote. With share owners, it's not that way. It's one share, one vote. But there are different ways we can go about that. Let's say that there are 3 people standing for election to the board. Let's pick these 3 ladies right here. Now, if you are voting and you own 1 share, then you can have 1 share for this race. You have one vote for this race, 1 vote for this race, 1 vote for this race. That's called straight voting. Now, you got 3 total votes here, but you can only cast 1 on each race. Let's talk about what that means outcome-wise. I own 50% plus 1 shares in the firm. You guys own the rest. I think she's great. You hate her. Who wins? I do, right? Because I got 50% plus 1. Okay, you say it. Maybe the next one. So we go to this one. I think she's great. You hate her. You all vote against her. Who wins? I do. Same situation here. I think she's great. You guys don't. We vote. Who wins? Do you see that I can elect the entire board of directors by having just 50% plus 1 votes? That sounds downright un-American, right? To allow someone who only has 50% plus 1 to control the whole show. And so we came up with something called cumulative voting. Cumulative voting. And so in the same scenario, the shareholders would still have 3 votes per share, but now they can concentrate them all on one race. And that allows them to be able to elect perhaps one board member to represent them. And so now, instead of having 0 representation on the board, they have someone who is kind of beholden to them. Does that make sense? Okay, so if, this is a great test question, by the way, if you are a small shareholder, you prefer cumulative voting. If you are a small shareholder, you prefer cumulative voting. And the reason is that if you didn't have cumulative voting, your votes aren't going to matter. If there's someone with 50% plus 1, they're always going to win. Okay, now, let's talk about what it would take to get one person on the board of directors. If we've got 3 races here, and for this formula, N would be the number of directors standing for election, it would be 3. And so I'm going to say 1 divided by 3 plus 1, which is 4, so that's going to give me a fraction of basically 0.25. I'm going to multiply that by the number of shares outstanding, and then add 1. And if I can achieve that number, if I can own that number of shares, have that number of votes, I am guaranteed to be able to elect someone. Now, you could elect someone with fewer votes than that if you could get other people to go along with you, right? If you could convince other people to go along with you, you wouldn't have to have that, but that's getting close to what we're going to call a proxy battle here in a little bit. Okay, now, you say, well, what good does it do to elect one director? Let's talk about the kinds of people who wind up on boards of directors. Retired Army generals, retired Navy admirals, the retired head of the American Red Cross. There's always a lawyer. You gotta have a lawyer. And there will be different kinds of folks. But what do these people all have in common? Number 1, we hope they're interested in representing the shareholders. And number 2 is they're supposed to be well-meaning people, so I guess that would go along with number 1. But number 3 is they don't know a damn thing about the industry. What do you think the head of the American Red Cross knows about Apple's business? I've got an iPhone, right? No. And so they really don't have any industry knowledge. And so who do they depend upon? The CEO. And so the CEO comes in and says, folks, I'm sorry to have to tell you this, but our earnings per share are going to be disappointing this quarter, but it's the same everywhere. Our industry is just in a slump, but we're taking some steps to cut costs, and we hope things are better in the next quarter. There's no one in the room to call that person out. What if you could get one person in there who was an industry expert? So let's take a current situation. What's going on with Boeing? They're doing bad, and why?
Planes keep on.
Yeah, people keep forgetting to put in bolts and crap at the factory, and now it's just like it's a sad and dangerous joke, right? Okay, now, and by the way, the Boeing CEO probably is walking into their board of directors and saying, hey folks, times are tough all over. I hear that in Toulouse, France, the Airbus people get the same damn problem. Now what if I had the retired CEO of Airbus as my director that I managed to get onto the Boeing board? What would happen then? Well, the retired CEO of Airbus, whom I will assume is French, will say, merde! If you don't speak French, ask a friend who does. Okay. In other words, this is like Americans saying horse crap, right? And then they'll say, look, this is what's really going on. This is what's going on in the industry. By the way, you can't trust this CEO. Now, think about the other, say, 11 members on the board. Who are they? Intelligent, honest, well-meaning people, we hope, right? Do you think they could be swayed from their current opinion based on the expert opinion of one outside board director? Absolutely they could. And so that's the value of being able to get one person on the board, right? So what if we get 10,000 shares outstanding? We said we were going to take 1/4 of that number, that's 2,500 shares. We would have to own 2,501 shares or have proxies for 2,501 shares in order to be able to get this done. By the way, did you guys have you seen the article yet that I sent you about being able to buy proxy votes? It's one of your discussions. Can you see how dangerous it is for me to sell my proxies for a couple of cents each to some yahoo who might use them to then get someone on the board who is absolute wingnut, right? It's dangerous. Okay, let's talk about different classes of stock. I mentioned earlier that there can be different classes of common stock. They're usually called Class A, Class B, and they have the same cash flow rights. Remember we said that was a sacred trust there, but they do have differential voting rights per share. So typically the shares that anyone in this room would own would only have one vote per share. But then there is another class for some firms that has more than one vote per share. For example, the Ford Motor Company. Anybody here drive a Ford? Okay, so your Ford is called a Ford. That's the name of the company, and that's the founder's name, right? Who's the chairman of the board at Ford? It happens to be a guy named Ford. Do you think the Ford family still controls 50% plus one of the shares at Ford? No. Oh no, they sold that off long ago. How do they maintain control then? Well, it turns out that the Ford family members, if you are a blood descendant of Henry Ford, or if it is a charity endowed by a blood descendant of Henry Ford, you can own this special class of shares that has 10 votes per share. Well, isn't that special? I can control the company now, only having 10% of the shares. Isn't that great? I can control the company. Now, that's great if you're a member of the Ford family, but what about for the other shareholders? Do you think it's possible that the Ford family would vote for things that would favor them that might not favor the other 90% of the shareholders? Absolutely. The Ford family are humans, are people, and people are scumbags. Now, luckily in the United States, we have strong institutions, and we have lawyers, boatloads of lawyers. And so the chances of them getting away with anything big are pretty low. But let's take this situation to another country. We're going to go to Mexico. I know you're from Guatemala, so I won't ask you a question about this. Actually, do you know who Carlos Slim is?
Yes.
Oh, he still knows who Carlos Slim is. By the way, does Guatemala share a border with Mexico?
Share border, yeah.
Yeah, okay. So he's close. It's like you know something about the United States, right? Okay, back to the story. Carlos Slim. Carlos Slim is a businessman, and he is friends with the people who are in charge. And then the Mexican government, which by the way had been running kind of this socialist thing where the government owns a lot of different of the businesses, they decided to start privatizing some of these businesses. And one of the businesses that they decided that they would privatize was Telefonos de Mexico. Can I get a translation? Telefonos de Mexico.
Teléfono de México.
Telephones of Mexico, right? Okay. So, Telefonos de Mexico. And so they decide that they're going to sell that. And now, so the way you should do a privatization is to do some sort of auction process or some sort of IPO. But no, not in a corrupt country where there's opportunity to take advantage. So what happens? Carlos's phone rings, and it's one of his friends in the government. He's like, hey, Carlos, we're getting ready to sell Telephones of Mexico. I know you really dig that company. Would you like to buy it? Carlos says, well, of course I would like to buy it, but I don't have that much money. And the government friend says, don't worry, we'll make you a good deal. Carlos says, hey, even at a discount, I can't afford that. And so what happens then? The friend says, don't worry, we can arrange funding, low interest rate loans for you from the Banco de Mexico, right? From the Central Bank of Mexico. Oh, now, I don't know that I have all of my details exactly right, but this is the general idea. Okay, so Carlos is like, hell, why not? And so he buys this at a discount with low rate financing, and now he's got it. And he's like, what do I do with it? He's like, I know, I could take it public, and I could sell off a little less than half the shares and get a boatload of money and still have control of the firm. But then he figures out, you know what, I could be even richer than that. Here's what I'm going to do. I'm going to create these two classes of shares. I'm going to have the regular people's shares, and I'm going to have the special Carlos shares. And the special Carlos shares will have 10 times as many votes. And so what Carlos is able to do then is take the company public and sell off 90% of the shares and still maintain control of the firm. Now, so far, nothing bad has happened. But here's what happens next. Carlos sets up another company that is 100% owned by him. And here's what he does. He forces Telefonos de Mexico to sell $1 billion worth of assets to Carlos Co. for $500 million. Okay, so basically what's happening there is that, so they're selling this at a discount, and then he uses his superior voting power to force them to buy the assets back at full price. And so in essence, Telefonos de Mexico has lost $500 million. Carlos owns 10% of Telefonos de Mexico. 10% of 500 million is 50 million. In theory, Carlos has just lost $50 million, yet somehow he's not crying. He's smiling and laughing and smoking a big Cuban cigar. Why? Do you remember the other company, Carlos Co? What percent of Carlos Co does he own? 100%. What was the profit at Carlos Co? $500 million. What's 500 million minus 50 million? 450 million. Carlos is laughing all the way to the bank. Now, why is that possible? Number one, we had a situation where they were privatizing these big government assets. Number two, Carlos was in tight with the leadership. Number three, corruption. Number four, naive investors. Do you think the Mexican stock market was really well developed and lots of savvy investors out there at the time? No. In fact, I wouldn't even describe the United States as having a bunch of savvy retail investors, right? We typically see people buying AMC because they read about it on some stupid Reddit, right? Okay, so you got to have those kind of people, and you got to have, then we've got to have courts where we can buy the decisions that we want, right, in case someone brings a lawsuit. If your home country is getting close to undergoing this privatization process, maybe you should make friends with those in power. Maybe they would help you out down the road, and you could be Carlos Slim II. And now you know how to structure the corporation so you can steal to your heart's content. Now, it sounds like Carlos has just made $450 million appear out of thin air. Whose money was it? Yeah, those other 90% of the shareholders, they're down $450 million, right? He has just used his superior voting rights to steal from the other investors. Isn't that sick? Yeah. Now, you may say, well, certainly we would never do that sort of thing this day and age in the United States. Google. And remember earlier we talked about Alibaba with Jack Ma?
Yeah.
Okay. Jack wanted to list his company in Hong Kong. And they said, oh, welcome, Jack, we love you. And then he said, I want two classes of shares. I want special Jack shares, and I want all you other shares. And they're like, oh, I'm sorry, Carlos, this is Hong Kong. We're actually trying not to be corrupt. We don't do that. And it's on the Wall Street Journal the very next day. This is the news got out. Then Jack Ma's phone rings. It's the head of the New York Stock Exchange. And do you know what he says? Hey, Jack, we hear you're looking to list on a major exchange. You know, those people in Hong Kong, they've got a bug in their ass about this dual class, this thing, but we don't. Bring it on. Where do you think he listed the company? New York, right? Questions? Now let's talk about preferred stock. Undoubtedly, you've heard about preferred stock. The name sounds like the stock is, you would prefer to have preferred stock to having common stock. And that's not why we call it that. We call preferred stock preferred because it has preference, meaning priority, for dividends. And it also has preference for the assets in liquidation. Remember we said we're going to sell off that stuff and then divvy up the holdings? How do we know how much goes to these? We know that the common shares are residual claimants. That means that the people ahead of them in line have to have fixed claims. And so if you own a share, a preferred share, you have a stated liquidation value. And just like the face value on bonds, we know it's 1,000. Canada, are you texting?
I got a word text.
Oh. So I'm telling you how not to get poor. And there you are, texting with your, how much do you make an hour?
Right now, 18.
18, well, that's actually pretty good.
Tax accountant. So
What's that?
tax accountant.
Oh, sweet.
Yeah. So
Oh, you're heading for big money.
I'm trying to.
Oh, okay. Back to the story. Stated liquidation value of 100. If we pay off all of the debt holders and everybody else before the preferred shareholders in line, then the preferred shareholders get $100 per share from the pot. And if there's anything left over, then the rest of it goes to the common shareholders. But if there's not enough in the pot to give everybody $100, then everyone gets a pro rata portion. So if I own 10% of the preferred shares, I get 10% of what's left in the pot. What about preference and dividends? Preferred shares must always be paid their dividends before common. And so we say that also preferred shares typically are cumulative dividends instead of the non-cumulative dividends we see for common shares. Let's talk about non-cumulative. What if I've been used to getting $1 per quarter from a stock, and this semester or this quarter they have a problem and they can't pay that? Do I get to say, aha, they owe me $1? No, that's gone forever, right? That's non-cumulative dividends. But if you've got cumulative dividends, you get to say, aha, they owe me $1. Most preferred shares are cumulative, and so the dividends add up. And not only do you have to pay the current quarter's dividend to the preferred shares before you can pay the common shareholders, you also have to pay the dividends in arrears. I spell that out because sometimes people think I'm saying the dividends in arrears, and it's not the same thing. So what does arrears mean? If your account is in arrears, you're behind on your payments, right? And so dividends in arrears are those dividends that they failed to pay in the past, that they have to pay those plus the current preferred dividend before they can pay any dividends to the common shareholders. This is one of the reasons that if you're going to give stock compensation to the executives, you give them common shares because you want them to be focused on making sure that these other people get paid.
So if they have to pay these arrears, but if dividends aren't liabilities, does preferred stock create a liability?
It's not a liability until declared, but, and they legally, they could just not pay those, right? But what that means is that they can't pay the common. And so it's not a legal liability to pay, but you got to pay it if you want to be able to pay the liability or the dividend to the common shares. So we had the CEO at Halliburton. His name was Thomas Cruikshank, which makes him sound like he was a crook. He wasn't. He's just an ordinary kind of thing. Okay, so we figured out his dividends were actually more than his compensation from the rest of his package, right? Now, do you think Thomas Cruikshank was very focused on making sure that we paid the preferred shareholders? Absolutely, because if we didn't pay them, what happens to his quarterly dividend payment? He doesn't get it. And let me tell you how this would play out at home. He goes home, and his wife says, Tom, when's the dividend check coming? And Tom says, sorry, dear, we couldn't manage to pay the preferred shareholders this quarter, so there's not going to be one. She says, Tom, how am I going to renovate the west wing of our mansion if you don't get your dividend payment? This conversation happens on a much smaller house scale at every household in the world, right? Do you think Tom would rather not have that conversation? Absolutely. So what's he going to do? He's going to try to make sure that they pay the preferred shareholders in a timely manner. Questions? Okay, now, preferred stock may look like debt, but it's not. Now let's talk about why it may look like debt. Number one, that stated liquidation value of $100 looks a whole lot like the face value of a bond, right? In fact, we said there's a default value, just like with bonds. And it gets even worse because the dividend rate, the way we talk about preferred stock is we'll say, oh, it's 5% preferred. What does 5% preferred mean? It's 5% times that stated liquidation value gets paid out every year. That looks a whole lot like a coupon rate, right? Looks a whole lot like a coupon rate. And by the way, those dividends, 5% of 100 stays the same for as long as you own that. And so those dividends are fixed payments that look a whole lot like coupons on the bonds. And some of these things have ratings, just like bonds. You talk about confusion. Now I've got AA minus preferred stock. It's starting to look a whole lot like debt. And then finally, some of them have an obligatory sinking fund. What does obligatory mean? That's something, it's mandatory. You've got to do it, right? Now, let's talk about why these might have an obligatory sinking fund. I'm going to tell you a story from the financial crisis. And in the financial crisis, by the way, lots of banks started to fail. And here's the problem. Once a few banks start to fail, what do investors assume about all the banks? They're all bad, right? And we saw, what was it, Lehman Brothers took a huge giant dump and died. And now everyone's looking at the other firms on Wall Street going, that sounds bad, right? And it turned out that Goldman Sachs, which was another firm on Wall Street, still around, they were actually in fairly decent shape. But it doesn't work for them to just come out and say, oh yeah, we're in good shape. Because what did the Lehman Brothers CEO say 2 weeks before they went belly up? Oh yeah, we're in good shape. Can you trust it when the CEO speaks? No, because people are scumbags. Now, the second thing you need to know is it might have actually been true when he said it. But if others lose confidence and start to pull their funds from the bank, then what happens? A healthy bank can fail through a bank run the same as a sick one. And so even, and Lehman wasn't healthy, but let's assume they were. Maybe he wasn't lying, but then people lose confidence and then suddenly his firm dies. Now, Lloyd Blankfein, who's in charge of Goldman Sachs, sees the writing on the wall. He's like, oh crap, we're next. He says, I've got to prove to people how great Goldman is. So what does he do? He calls up Warren Buffett. You guys know who Warren Buffett is? Yeah. He calls up Warren Buffett and he says, hey Warren, how are you doing? And Warren says, cut the crap, Lloyd, what do you want? And Lloyd says, well, he says, we've been, Goldman Sachs is in really good shape. We've been trying to figure out a way to signal to the markets that we are safe. And we thought that the best way to do that was to have the most legendary investor ever. At this point, he's just shamelessly kissing Warren's ass. He says, the most legendary investor ever to invest in our firm. Warren says, go on. And Jeff said, Lloyd. Lloyd says, we were thinking you might, buy some common stock. And Warren laughs and laughs. He says, no way. He says, I'm going to buy preferred stock. Why does Warren insist on preferred versus common?
You just on the line and get back.
Yeah, if things go terribly wrong, he's gonna get paid before those schmucks at the end of the line, right? Now, would, you say, well, wait a minute, he could have easily said, I want to buy debt. The problem there is that debt has fixed coupons, and if you don't make the coupon payments, it drives the company into bankruptcy. Preferred stock doesn't have that. Now, surely you've got the dividends and arrears, but you're not going to be driven into bankruptcy by the preferred shareholders unless you're stupid enough to declare that dividend. Okay, so it puts the preferred shareholder in a position to recover more of their investment, but it doesn't put them in a position to drive the company into bankruptcy. So there's a little bit of something there for both people. And so Lloyd says, yes, we could do preferred. And then Warren says, what kind of rate were you thinking about? And of course, Lloyd wants it low. He says, 5%. Warren laughs. He says, let's make it 10. By the way, 10% money in 2009, cheap or expensive? It's expensive, right? And so Warren says, or no, Lloyd, sorry. Lloyd says, okay, but you've got to give me, we've got to be able to have the obligatory sinking fund so I can buy that back, because I don't want to owe 10% money to you forever, Warren. And Warren says, okay, I can live with that. And so that's how the situation gets set up. So, from that story, why do you think people might have preferred shares in their capital structure? First of all, is it required for firms to have preferred shares? No. And so to me, when I look at a balance sheet and I see preferred shares, it tells me that they might have been in trouble at one point or another in their existence, right? Now, I would love to know if there are other reasons for preferred shares. If you run across any, please email me and let me know. But that's the only one that I know of. Okay, questions? So far, this is looking a whole lot like debt. Let's talk about why it's not. First of all, preferred dividends are not tax deductible. Preferred dividends end up down there with the common dividends down below net income, and we're trying to figure out our addition to retained earnings. And so there's your first clue. And the second is something that I've already mentioned, and that is that the preferred shareholders cannot force the company into bankruptcy. And that's why it's a popular form of financing during times of financial distress. Questions? So let's talk about stock markets. And we're going to cut this pie in several different ways. And the first way we're going to cut the pie is in the idea of primary versus secondary. A primary market transaction is where the money flows directly to the company. A primary market transaction is where the money flows directly to the company. Example, IPO. IPO, that's the first time those shares are outstanding, and so that money flows to the issuing company. So that's a primary market transaction. Now we have something on down the road called an SEO. When the company needs to issue more equity, they do what is called a seasoned equity offering or a secondary equity offering, SEO. Do you think that is a primary or secondary market operation? Yeah, it's primary. This is an easy way to trip people up. It's primary, and here's why. Give it the test. Who gets the money? The company gets the money. If the company gets the money, it's a primary market transaction. By the way, do you think we could also have primary market transactions for bonds? Yeah, when the company issues the bonds for the first time, that money comes to them. What about secondary market transactions? That is when one investor sells the asset to another investor. So for instance, I forget how many shares I own in GE. I think it's like 10 if they haven't split. 10, if I want to get rid of my shares, I'm going to go out there and sell my 10 shares of GE to another investor. Is GE getting any money from that at all? No, GE's not getting any money from that at all. That is a secondary market transaction. Now you might think that a company doesn't care about secondary market transactions at all, but they do, and here's why. First of all, if my stock is more liquid, meaning that you can get in and out of it easily, then people don't require as high a return on it. It's just like the bonds that we talked about. So I have a lower cost of equity if my stuff's out there trading easily. And the second is knowing what the market's value is on my shares help me to value the firm. And so if someone comes by and makes an offer for the firm, I will know whether it is a good offer or not. If it is above what the stock market says my firm is worth, I should consider it. If it's below, I should tell them where to get off, right? And so it tells me what the firm's worth. It also helps you to understand whether you're making good decisions or bad decisions. So, for example, let's talk about a certain brewery, a certain international brewery, who decides to enter into a sponsorship arrangement with a certain individual to have their picture on a bunch of social media. Now, as soon as that news hits, what happens to the share price of this famous international brewery? Right in the toilet, right? Do they have instant feedback on whether or not that was a good decision? Yeah. And so, now, here's the bad part though. Do executives pay as much attention to this as they should? Absolutely not. They'll announce stupid things that they're planning to do, and the share price goes down. If you're a good CEO, you should say, wait a minute, we were just kidding. That was April 1st announcement. Yeah, we're just messing with you. Example, Netflix. Back in the day, they were going to spin off their DVD business into something called Quickster, and they were going to sell that. And the share price just takes a huge dump. And for once in the history of the universe, the CEO says, damn, and reverses their decision, right? Be that person. Be the person who's willing to reverse their decision when they're proven to be stupid. Okay, now let's talk about dealers versus brokers. A dealer holds an inventory and stands ready to buy or sell. We talked about them with bonds. A broker is someone who arranges a sale in exchange for what? A commission, right? And so we've got dealers and brokers here. And those dealers are involved in dealer markets. Now, dealer markets is where you have to work through the dealers to buy or sell. So, dealer markets, we know that bonds are a dealer market, and we have some stock markets that are dealer markets for equities. For example, NASDAQ. What do you think the D stands for in NASDAQ? Yeah, it's the National Association of Security Dealers Automated Quotation System. Although they would have you believe it doesn't stand for anything, kind of like the KFC people don't want you to remember that it was fried chicken, right? Okay, so it's NASDAQ. The D stands for dealer. And so we've got NASDAQ and we've got these OTC pink sheets. And usually I go into a diatribe. I don't have time. But usually I go into a diatribe about how you should not buy stocks, OTC or pink sheets. And if you want to know why, go out and download The Wolf of Wall Street and watch that movie. And you will see what happens to the people who get suckered into buying this trash. Don't be them. Okay, now let's talk about the auction markets. Some of you guys in your heads, most of you probably have a picture in your head. When you see the stock market, you think of a bunch of people in different colored blazers and they're yelling stuff and doing finger signs, and then the bell rings and they throw the crap in the air. Those are auction markets. Those are auction markets. If you look at the New York Stock Exchange, you can say as a physical location, right? And so I went to New York City in 2010, and I went down to see the New York Stock Exchange. I couldn't get anywhere near it because of the security, but I could look at it. It was there. Used to you could go in, right? You could go in and watch. Where's NASDAQ? It's a computer network. So it's everywhere and it's nowhere. It's a computer network, right? And so right now, that we've got Wi-Fi in this building, NASDAQ is flowing through your body. Doesn't that sound creepy? But it's everywhere and it's nowhere. A lot of people are like, oh, wait a minute, I saw NASDAQ in Times Square. I'm like, do you mean that big round sign that lights up? They're like, yeah. I'm like, it's just a freaking sign, man. That could be for Adidas. Okay. So there's our division between dealer markets and auction markets. Let's talk about the New York Stock Exchange. Used to be people would have a seat on the stock exchange that allowed them to trade commission-free. The New York Stock Exchange did away with that, and became a publicly traded firm, at which point each one of those seat holders was given a portion of the equity in the new firm. And now they sell basically licenses. And the license holders break into these different groups. The first of all are the designated market makers. For every stock on the New York Stock Exchange, there's what's called a designated market maker. And in reality, they are a tiny dealer. They hold a small inventory and stand ready to buy or sell. They have their own bid and ask posts. However, they would be the most expensive way that you could trade on the exchange. So you want to avoid dealing with them if you can. In exchange for this nice posh spot that they've got, they also have to record all the transactions that happen, not including them, but between other people. And so that's all the dealings for, say, Walmart stock happens at precisely one place on the New York Stock Exchange floor. Now, then we have floor brokers. Floor brokers are working for people like, they keep buying each other. Charles Schwab, Merrill Lynch, people like that are out there selling for their clients and receiving a commission for it. That's the floor brokers. And then there are these people called supplemental liquidity providers. They've changed all these names to make them more complex. We used to call supplemental liquidity providers floor traders. And here's what a floor trader is. It's someone who A, has the license, B, they are trading on their own money. And they stand on the floor of the exchange and they trade based not on fundamentals, but on emotion. Have you ever been in a crowd and you recognize the point at which the crowd went from being happy to being angry? Yeah, when you're told you've been waiting in line for your flight to Hong Kong for 4 hours, and then they tell you that the cruise timed out, and that you won't be going until tomorrow, and that you'll have to stay in some flea-bag hotel where you'll probably get bed bugs. What do you think happened to the emotion of the crowd? By the way, you think this is a true story? What do you think happened to the emotion of the crowd? Oh, I heard profanity in like 27 different languages just right then. Okay, now, do you think the same thing could be said on the floor of the exchange? Do you think you can tell when it goes from greed to fear and back and forth? Yeah, and so people, these floor traders, trade on that, and as a result of their trading, they're there to buy when other people are getting out, and they're there to sell when other people are getting in. That's why we call them supplemental liquidity providers, because in order to trade, in order for the market to be liquid, there has to be someone to trade with. By the way, do you think you could be a supplemental liquidity provider for very long if you were bad at it? No, you'd lose your money, right? And so if you hear someone doing this for 10, 20 years, they must be extraordinarily good, because they should end up bankrupt if they're not.
So when I buy a stock through E-Trade, is it through NASDAQ then?
It depends. Oh, it gets really messy now. If you buy, let's think of a stock that just trades on NASDAQ. If you get a stock that just trades on NASDAQ, absolutely. But sometimes now we've got shares that trade on both New York Stock Exchange and NASDAQ. And so you don't know. It could go through one or the other. And now the New York Stock Exchange has actually started electronic trading on its own. And so it has both this electronic portion and the physical floor. In fact, the physical floor is usually only active for the first hour of trading every day. And then once the big is over, then it gets really slow and they start eating pizza and watching DVDs because there's no Wi-Fi. It's in the Wall Street Journal. So, long story short, used to it was really easy. If I'm buying AT&T, I know where that sale's happening. It's the New York Stock Exchange. These days, it's just almost impossible to know. Good question. Okay, let's talk about how things work at the New York Stock Exchange. We've got people wanting to buy and sell. And what happens is those people have to meet at the designated market maker's post, this specialist, and what they want to do is work the crowd. And so let's say that the designated market maker says that their ask is 101 and their bid is 100. If you and I want to do a deal on that, we'll get together and we'll make it a deal to do business at $100.50, right? It saves us both 50 cents and the deal gets done in the crowd. Then we take our deal to the designated market maker and they record the deal. If there's no one else around, I have to do business with the DMM and I end up with that bigger bid-ask spread, so I lose more money. Okay, so that's the operations. I think, oh, I've already talked about NASDAQ. By the way, ECNs, Electronic Communication Network, allows you to trade after hours in your underwear. Is that a good idea? No. You're trading against pros out there. And number two, you're probably high. Number three is the bid-ask spreads are huge in the night. I'm not kidding. If you don't believe me, get up sometime in the middle of the night and look at the bid-ask spread on Apple. It's amazing. Now, here's what I would tell you to do. Go to my video that I have posted for the class and go to the end and watch what I say about the stock quotes online, because there will be a lot of extra information there, help you to learn how to be able to read those things, and will help you to be able to answer one question on the exam at least. Are there any questions?